Let me report to record. We have started, by the way, London live trading session. So I was saying I've realized that when you don't need the money, you tend to make it in trading. I don't know why. I don't know how it works. But my um immediate understanding would be there's less pressure. So you are much more willing to wait for the right opportunities than just trying to get involved anyway because you need to make money, you know? And I was saying what I can, we're back. We're back. Let's get used to these glitches. Um, joking, they'll be sorted into time. So I was saying, um, what I can guarantee you is that you will make money in the long run. So I was saying trading is more about avoiding the bad trades than finding the good ones. Don't know if I'm making sense. The most amount of work you're going to do is avoiding the bad trades than taking the right ones. And let's be honest, the right trades are very few compared to by the way, am I still sharing the same thing? Please let me know if you can if what you see is the Euro AUD chart. So yeah, let us begin today's session with the analysis and all of that. I think we can, it's either we look at the headlines or but I think what will help us a lot, it is the Forex victory calendar. By the way, the next boot camp is coming up. We're supposed to be doing this every second week of the month. The next boot camp is coming up. So if you haven't muted yourself, please do so. All right. So, and if there's something that you need us to look at, we're going to be rushing through this quickly, but still using the same concept. Put it in the chat. I'll have a look at it. So today is Wednesday, the 12th of February. High impact news are going to be later on the day on affecting the US dollar, more CPI news. And the chairman of the Federal Reserve, Jerome Powell, will be testifying today. Normally, the market moves in crazy ways. Or crude oil inventories. Oh, so this talks about the reservoirs or let's look at it. It measures the change of number of barrels of crude oil held in inventory by commercial firms. So supply and demand wise, if there are more barrels held by the crude oil inventories, that means there's more supply for oil, and that would mean that prices would have to go down because we have enough supply of oil. If what is expected, if what is expected, it is for um it's for the crude oil inventories to go down, or the reserves, or the barrels, the numbers in millions of barrels to go down. If it goes down, then you anticipate prices to go higher. Why? Because there's always a high demand for crude oil, and when prices when there is less supply, the prices will go high. I think we saw that when there were wars in the Middle East. So that meant the supply of oil to the rest of the world was threatened. Oil prices just shot all the way up, almost hitting the 100 territory. So we're going to look at crude oil as well. We can also look at trading economics. Even though we don't use economic news that much in our trading because we understand supply and demand, the relationship of buyers and sellers, I think it's very good to have an idea of what's going on from the macro picture or the economic side of things. So, US inflation rate expected to hold steady. That is the CPI, which is expected later during the New York live trading session. Brent snaps 3-day advance. So Brent oil has been advancing to the upside. I had this set up. I haven't taken advantage of it because there's something missing. Um, I felt like it turned on a fair value area. So that's not a very high probability area. So European markets poised for higher open. Um, Japan machine tool orders ease in January. Not very good news. China stocks rise on AI boost. What's the new AI that's from China? DeepSeek, rivaling OpenAI and all these other US tech companies that will lead us in the AI space. So it's very important to know what's happening. I think a key news event here is Jerome Powell reaffirming that the Federal Reserve will no longer cut rates further this year. We'll see how the market works. So I was reading through this. I know someone is confused somewhere. Someone is confused somewhere. How do I even use this to my advantage? Trust me, with time, you're going to understand it. So, relationship between fundamentals and technicals, very important. Um, we're now going to go into technical analysis. So, fundamentals give you a bias. Fundamentals give you a bias. And I would like to correct this notion that fundamentals control the market. No, they don't. Um, but what news events do, I will always emphasize this, they invoke two human emotions which are seen in the chart. So whenever someone is feeling positive about that the US will no longer cut interest rates, they're going to invest in the US and you're going to see the US dollar gaining value. But if whatever value comes out of for the CPI today, um, maybe something different from the forecast or the consensus, out of fear, that person is going to sell and we're going to see the market going down. And what happens if people are on the fence about the information that came out? You're going to see the market consolidating. My main goal it is to make you see or understand that the markets aren't complicated. We are just complicating it. We think it should be complicated. It's not. It's just a relationship between buyers and sellers. And if I can't explain this in simple terms, that means I don't understand it myself. So yeah, let's jump to it. Start with the dollar index as always. We normally look at the dollar index. Why? We want to get a bias, want to get an idea of the direction of the US dollar compared to other markets, or let's just say the US dollar as a whole. Just a reminder, ladies and gentlemen, about how we trade here at Wall Street Institute and Company. We are in harmony. We are always in harmony with the markets. What do I mean by that? So the market was meant for this. Every market in the world, even the black market, I know it's unregulated, but it was meant for this. Every market in the world, it was meant for this. Why is your nearest vegetable market there? It is so that someone who has vegetables to sell can have a place to sell it, and someone who wants vegetables or wants to buy vegetables, they can have a place to find vegetables. And that agreement between the buyer and the seller is what regulates price. The market was meant for fair price, for fair value. So when I say we trade in harmony with the markets, I mean, this is going to sound uh, crazy. So here there's an agreement between the buyer and the seller. So which means supply is equals to demand at this particular area. So the buyers and the sellers are in agreement. And what you will notice about this kind of price movement is that it will be the most common one
Mhm.
that you see on the charts, because that is where buyers and sellers are happy buying and selling. But you have to know that this is not where traders like me and you, or speculators, let me put it like that, make money. We make money where the market is out of balance. We make money when the market is out of balance. So at this particular area, what you'll notice is that we had more sellers. Let me not talk in supply and demand. We had more sellers than buyers.
Hmm? Normally ukuthi ngikaphathile.
At this particular area, we had more sellers than buyers. So what does this
Huh?
mean? It means up here.
Ukuthi umuntu
I'm
ohlupha
sorry,
nje
sorry
ngawo
about
wena.
the noise. Um, it means up here there is a seller that is not happy because no one is buying from them. So what is price going to do? Price is going to go down to look for buyers. Why? Because lower prices favors buyers. All right, let me try to mute. Um, if you haven't muted yourself, please do so. Please do so so that the rest of the group can. All right. So yeah, I would say at fair value, this area. Maybe let me do some further annotation here. It's fair value price. Why is this fair value price? Because buyers and sellers are happy, or a buyer can find a seller and a seller can find a buyer at this price. So they're transacting. So if there are more sellers than buyers at this area, so this means that there's a seller that's not happy. So the market will come down. When it's coming down to find a buyer to meet the seller. So once those buyers are found, then price is going to move from down here up to that area. And once there is a balance of orders, this is what you will see. Once every buyer has met a seller. But as soon as there are more sellers than buyers again, price is going to drop. So remember this, where our opportunities are. I'm going to mark. I'm trying to do this lesson so that I know there are new people that has joined us just today, so that you are not confused once we start analyzing the actual chart. You have to understand that we avoid this area, but we trade this area. One of the reasons we avoid the consolidation area or fair value price, which is this area, it is that when you look at the profit margin at fair value, let's say you're selling at fair value, selling at resistance, targeting support. You see, you can get a 1:4, but if you're gonna trade up there and aiming for the same target, now you get a higher risk to reward trade. So we want to get involved where there's a higher chance, higher probability, and also where there is a higher potential reward that you can get from the market. So one of the reasons we avoid this area of fair value. I hope that makes sense. So it also does happen, or let me ask you, why did price push up here? Who has an idea? From this area, why did price push up? Don't say it's demand. I think everyone can see that. Why did price push up here? One would say there are more buyers than sellers. There are more buyers than sellers. Why did price push up here? Price went up to look for sellers. Price went up to look for sellers. Pindi says orders. Yes. So to answer why did price push up? It is because there is an unsatisfied buyer here. There's a buyer um, whose order was not met. So when price goes up, it's to look for sellers. And once it finds sellers somewhere around fair value, it's going to drag them down to that area. And then once those buyers are met, price is going to consolidate to show that now there's fair value. And how do you know that market has found direction now? The market is going to, let's say, maybe let's say even if it goes lower than this and it finds more buyers, and if there are more buyers than sellers, again, price is still going to push a bit higher. So the process continues on and on. What I need you to remember is that we trade on the highlighted zones. Okay. So look at the golden highlighted zones. So this is our supply and that is our demand. If I would put it maybe like this, so we avoid fair value price. That's it, ladies and gentlemen. I hope that has made sense. Let us go on to the chart. So how do we find buyers, or how do we determine direction? Sorry about that. How do we determine direction? So first things first, let me remove all the drawings that I've said. So first things first, we look at the monthly time frame, highest time frame, right? Higher time frames to me is the daily, weekly, and monthly time frame. So the ideal situation that we're looking for here is so that all three time frames are telling us the same story or giving us the same direction. If not, we will follow the direction of the highest time frame. But the ideal situation is that all of them should be giving us the same direction. So we look at the current candlestick on a monthly time frame. So look at where this candlestick opened. The opening price was here at 108.516, and we are trading below that. So that means for the monthly time frame, we're bearish. Let's move on to the weekly time frame. We're trying to see how is it moving. So the weekly time frame, current candlestick is this one. So here's where it opened, around 108, 100, and we're trading below that. So we're bearish. Seems like everything is going well up until this point, right? And then we go to the daily. On the daily time frame, we have current candlestick or current here it opened here, current price opened here on a daily time frame, and we're supposed to be trading above that. So we are bearish on a monthly, weekly, but bullish on a daily time frame. So that is not the ideal situation, but at least we have two time frames that are in agreement, and it is the two highest time frames, the weekly and the monthly time frame. Why do you need that information? You need that information so that you can decide whether to be a buyer. Right now, we have a bias. Now we understand that to be successful in this market or in the US dollar, we have to be looking for selling opportunities. All right. Then the next question is, where do you need to sell? That is when we talk about market timing, where and when. So now we're going to look for our supply and demand levels. I hope you guys understand that I'm giving you gold. I'm giving you gold. It's up to you if you're gonna use it the right way. Okay. So now that we understand that we have to be sellers. So what are we looking for? Remember, we're looking for um, an area of imbalance. So we're looking for an area of imbalance. So which means as soon as you see this, consolidation, then you know that we have to avoid this area. Okay, so you look above or below that, but because we're looking for supply areas, we have to look above that. The nearest supply area is this one here at 108 700, or you can say 109. I'm pretty sure there are other supply levels if you go further up to 110, but the nearest one is this one. So what does this mean? It means for your USDJPY, USDCHF to sell on those as well, wait for price to come to 109. and you can anticipate it to go down. One other thing that you should be careful of, it is your language when you're trading, because it can also be the difference between you making it and losing all your savings and in a trade. Language is very important. It's going to determine how you act. When I say there's a potential, it means I'm not sure. It means I'm thinking in line with the market. There's a higher probability. It means I'm thinking in line with the environment that I'm trading, because the environment that I'm trading speaks in terms of numbers, in terms of probabilities. Nothing is guaranteed here. Okay. So find an edge, execute that edge, and you'll be good to go. Um, let's look at USD So using the correlation rule, let me remove the old drawings. Using the correlation rules, the importance of understanding fundamentals and bias is that now that we have made some analysis, now that we've made some analysis on the US dollar and we understand that we need to be bearish on the dollar, um, it's also not surprising. After the inauguration of Donald Trump, 47th president of the United States, what we saw happening is um, it was good for the first few days, and then he started attacking the rest of the world with sanctions and all of that. So it is still not clear where the US is going. And um, when we did our analysis, we found that the dollar is losing value. How nice is that to see your fundamentals connecting to your technical? It's really great, isn't it? So that's why I'm trying to teach you guys to be in harmony with the market. I'm not a signal provider. I'm not going to tell you what to buy and sell, but I'm going to try by all means to make sure that you understand this thing that you think it's complicated when it's really not. It is really not, ladies and gentlemen. It is as simple as they come. So let us find direction. So we do the same thing across the board, ladies and gentlemen. If you want to be consistent, have a consistent approach in the markets. One day, my mentor once said a few years ago, probably 9 years ago, he said to me, Maxwell, you cannot want to be consistent as a trader or to have consistent profits if you're not consistent with your risk. If you're risking 0.5% today, 1% tomorrow, and when you're feeling invincible, you're risking 10% of the account, or in the worst cases, risk everything, you will not find consistency. So consistent risk will equals to consistent results. Consistent approach will equate to consistent results. So let's go, ladies and gentlemen, find direction on the USD JPY. We have an idea already that based on our analysis on the dollar index, that the dollar index is bearish. So we should anticipate some bearishness here. But let's confirm. Opening price of the current month was around 154,700, and we're trading below that because this is where current market price is. And as you can see, we're bearish. So let's go to a weekly time frame. Weekly time frame proving us otherwise. Current candle is showing us some bullishness. So this is not the ideal situation that we always look for. So as I've said earlier on, when we encounter this situation, what do? We find um, sorry, when we encounter this situation, what do? We follow the higher time frame, which in this case would be the monthly time frame. So now that we're clear on direction that we need to be looking for selling opportunity, then the question becomes where and when. This is where supply and demand comes in, right? The where, you know that it is not in this area of fair value, because supply and demand zones that you find here are of less probability. Let me prove to you. Let's go to a 1 hour time frame and focus on the fair value price. Wi-Fi is very slow, but we're gonna get through it. I hope you're enjoying this. Give me a thumbs up if it's clarified